we are definitely on one of the craziest roller coaster rides in history. Just last week, the stock market lost over $6 trillion in 2 days. This was then followed by one of the biggest jumps we have ever seen since World War II, which of course didn't last as the stock market fell sharply right after that. As the trade war continues to escalate, recession fears are rising and rising bond yields are threatening to strain the global economy. As investors, what is the best move that we can make? Should you get out before things get even worse? Or should you continue to buy the dips in hopes that things will eventually recover? Now, just to be clear, I have absolutely no idea where the stock markets will go, whether it's in a few coming weeks, months, or even years. And anyone that claims they do is probably lying or orange in color. But then, with the future being so uncertain, especially more so now, how are we even supposed to decide how to invest going forward? I think one way to approach this is by looking back in history, because while the past doesn't predict the future, sometimes it can offer us some much needed perspective. So whether you have been investing for a while or are just getting started, you would have probably heard of the fact that the S&P 500 returns an average of about 10% a year. While that sounds attractive, the truth is that the market doesn't just give a flat 10% every single year. If that were the case, there would be no risk and the stock market would not offer such attractive returns. Instead, over the past 100 years, there were only 6 years where the S&P 500 gave close to 10% returns. In most years, it either gave wildly higher returns or depressingly lower returns, or somewhere in between. But if you group them out by either positive or negative years, you see that in more than 70% of the time, you get a positive year, which means the odds of you finishing the year higher than when it first started are actually pretty good. However, the problem with this is that it hides the true picture of what is really happening within those years. Instead, this chart tells a much clearer picture. What it shows is that every year, no matter whether it ends in the green or red, there's always some sort of a drawdown in between. Take for example the year 2009. That was the year the S&P 500 hit the bottom of the 08-09 crash and went on to deliver a 23% return. However, during that same year, it also saw a huge 28% drawdown. In fact, drawdowns are so common that on average, the markets would usually experience a 5% drawdown around 2 times a year. Then every 18 months or so, we would see a 10% correction. And roughly every 3 years, a more significant drawdown of 15% or more tends to occur. The last time the S&P 500 has seen any huge drawdowns was in 2022, which means the drawdown that we are experiencing right now is actually right on schedule. Quick pause. Usmart has recently lowered their US trading commissions to just 88 cents per trade, offering one of the lowest fees among brokers for investing in the US market. And to sweeten the deal, Usmart has also rolled out a zero-cost regular savings plan. With ongoing market uncertainty and rising concerns about tariffs and volatility, dollar cost averaging into eligible US and Singapore stocks and ETFs is the smarter way to stay ahead. With Usmart's zero-cost RSP, you can now pay zero fees while riding out market swings. To enjoy this promo, just open up the Usmart app, go to Trade, Regular Savings Plan, and select the stock that you want to invest in. And here, you can start investing with as little as $100. Usmart supports automatic e-gyro deductions, which will allow you to automatically deduct funds from your bank account. This lets you skip the hassle of manually transferring in every time. You can then choose your preferred investment frequency from every trading day to every month. New users who sign up with Usmart now will receive up to $202 worth of welcome rewards, including share vouchers, cash vouchers, and free US and Singapore market live pricing when you fulfill the terms and conditions. So sign up to Usmart using my link down below to take advantage of this exclusive offer. Let's get back to the video. However, the thing that is causing so many investors to worry is that this time it feels different. Because for the longest time in history, the world has been enjoying global free trade along with the relative peace that came with it. But now, one single man is threatening to put an end to all this while reigniting fears of trade wars and rising global instability. And as the Singapore's Prime Minister warned, the last time this happened, it eventually led to World War II. This can certainly feel very unsettling because who knows what might happen next. But the same could be said for any point in history, because if we look back at every single drawdown, there's always something to be worried about. For example, back in 2023, we saw multiple banks collapsing due to the high interest rate environment, and the fear at that time was that this could spark a broader financial crisis, similar to that of 2008. Then in 2022, Russia invaded Ukraine, and people were speculating that this could escalate into a larger regional conflict or even trigger a global war. Then, of course, in 2020, the pandemic brought the world to a standstill, and no one knows how long it will last. Each time, it felt like the world was on the brink of something far worse, and recovery might be impossible. Yet, time and time again, the market defied expectations and continued its upward trajectory. Now, I don't want to downplay the seriousness of what's currently happening, because for all we know, this time is indeed different, and things might finally turn out badly. But it's also worth remembering that this isn't the first time the market has experienced great uncertainty, and it certainly won't be the last time. If anything, history has shown us that the market is far more resilient and stronger than we often give them credit for. Because not only the market has recovered from past crises, it has also gone on to deliver greater returns over the long term. For example, the S&P 500 might look scary over the shorter time frame, but if you just zoom out over longer time frames, you will barely even notice the drawdowns. If you invest for just 1 year, there's about a 26% chance that you could end up with a negative return. But if you stay invested for at least 5 years, this risk drops to just 10%. Over 10 years, it falls even further to just 3%. And if you invest over a 20-year period, historically, the chance of ending up with a loss drops to 0. I guess there's some truth to the saying, time heals all wounds, even the stock market. But of course, that's over the long term. And given how things look so scary and uncertain now, you might be thinking, maybe this isn't the best time to stay invested, and perhaps I should just wait on the sidelines until things feel more certain. After all, if we look back at history, the last major global trade war in the 1930s triggered a market crash of nearly 90% and led to the Great Depression. So maybe it could happen this time round again? So let's look at history to see if sitting on the sidelines is actually a good strategy or not, and how often it has really worked out. Over the last 95 years, whenever the S&P 500 has seen a drawdown of 20%, after 1 year, it was up 8 out of 12 times, while giving an average return of 11%. After 3 years, 10 out of 12 times, while having an average return of 24%. And after 5 years, while the number of positive years remained the same at 10 out of 12 times, the average return has gone up to 44%. So, as history shows, the odds are overwhelmingly in our favor. And perhaps the biggest clue of what might happen next is that even though this whole crash is largely caused by one man, he has also shown that he can quickly flip the other way, which could result in the market shooting back up. And if anything, even he also wants to avoid triggering a depression, which suggests that there's a limit to how far he's willing to go. But then again, maybe he doesn't care? Who knows? The point is, if you have just sat on the sidelines and the market shoots back up, it will cause you to lose on a lot of returns. Over the last 20 years, if you have stayed fully invested, you will have gotten a 10.4% average return. But if you just miss out on the 10 best days out of the 20 years, your average return would drop to just 6.1%. Miss out on the 20 best days, the return would drop even lower to just 3.5%. Now, of course, you could always try sitting on the sidelines before things get worse, like what Warren Buffett did previously. Then jump back in just in time to catch the recovery. But what makes this timing so hard is that 7 of the 10 best days usually occurred within 2 weeks of the 10 worst days. This chart shows this a little more clearly. What you can see is that the best trading days, as represented by the green bars here, often occur close to the worst trading days. And because of how close they are to one another, this makes the prospects of successfully timing the markets almost impossible. Here's another one. What it shows is that the longer you stay on the sidelines, the more likely you will underperform someone who stays fully invested. For example, if you just sit out for 3 months, there's a 61% chance you will underperform, with a medium lag of negative 1.6%. And if you wait for 6 months before coming back in, that probability jumps to 72%, with a median underperformance of negative 5.5%. Most people think that the biggest risk in investing is investing in the wrong thing, or market crashes, or volatility. But probably an even bigger risk is how you react, especially during times like this. Many people believe that the more they do, the higher returns they will get. But the truth is, more activity often just means more chances to make mistakes. This is called the behavior gap, where if you just did nothing, your investments would have given you this much return. But due to emotionally driven decisions, your actual returns could be lower. For example, from 2002 to 2021, S&P 500 delivered an average return of 9.5%, but the average investor only achieved a 3.6% average return. The stock market is this weird place, where the more things become cheaper, the less you want to buy, and the more expensive things get, the more we want to buy. But I guess this is perfectly normal, and that is what makes us human. Because let's face it, who on earth would want to throw their hard-earned money into something that has the potential to go down even more? Perhaps this is what being a successful investor is about, and it is the ability to stay the course even when everything looks seemingly bad. And I think the term buy and hold long term is much easier said than done. You can never truly escape risk, but you can change how you as an investor accept risk. That's why for most investors, the best method of investing is passive investing, where you just go with a well-diversified index fund and ETF and just set up regular investments to automatically invest. That's it. The simpler your investing strategy, the better it is for you, both in terms of your market returns and your mental well-being too. Because let's face it, you already spend so much time and mental energy on your work and life, and investing shouldn't be another source of stress. With passive investing, you will not only prevent yourself from making emotionally driven decisions, but at the same time, you are also placing your faith in the long-term resilience, ingenuity, and progress of humanity, which so far have worked out quite well. And if it doesn't, well, let's just say that money would be the least of our problems. Personally, I have a feeling that 4 to 6 years from now, we will look back at today and wonder, why did we even get so worked up in the first place? And by then, there will be probably another new thing to worry about. But hopefully at that time, like all things, we will have grown just a little wiser as investors. Anyway, that's all for this video. Hope you found it useful. Like, share and subscribe as I'll be posting new videos every week.